All right, well, joining us on the line today is Barry James Dyke. You've heard him here on the program before. He is the author of a brand new book, Guaranteed Income, a risk-free guide to retirement. Barry, it's great to have you back on the program. Thanks for joining us.
Well, thanks so much for having me, Jerry, and I always admired what you're doing, and it's always an honor to be your guest. Thank you.
Absolutely. And as you well know, those of you listening, Barry James Dyke, as you may know, I should say, is a part of our Christian Financial Advisor Network. He provides retirement solutions to people in the New England area where he lives. I imagine it's pretty cold up there about this time of year.
Yep, we have a full-blown snowstorm going on today.
Oh, my gosh. Well, we'll count ourselves lucky down here in the South. Well, taking a look at this book here, Guaranteed Income, I've got to tell you, as I'm looking through this book, I was just telling you off of the air that this thing is unbelievably compact for what the packet punches here. I mean, this is an amazing little book. The Collapse of the American Pension, Chapter 1. Chapter 2, New Risks in Retirement. Mutual Funds Are Not Delivering the Solution. And you go through and you talk about not just that, not just about the retirement crisis, the fact that, the whole pension system has gone away and now employees are on their own to defend themselves from the sharks on Wall Street. But on top of that, you go into and explain, and I think this is the best part that'll blow most people's minds, is you explain how the guys who concoct this stuff, the guys who actually foist this upon the American population, they themselves do not eat their own cooking. Tell us what you discovered in this book.
Well, that was a real blessing, Jerry. As you know, I've been researching this for a good number of years now, 10, 15 years. But this is the folks who make billions speculating off your money, the biggest asset managers, the J.P. Morgans, the Banks of America, the Wells Fargo, and the PNC banks, and even all these huge financial institutions, even the Federal Reserves and part of this scam, they all use the guaranteed product, which I recommend in this book. So it's complete and total hypocrisy, Jerry. But as you know, I like to document things, and I'm a doubting Thomas of the first order. So I documented everything. So yes, although Wells Fargo sells, I think, like $2 trillion under assets under management, whatever, selling speculative products. And if they're in the market today, Jerry, the market's getting hammered today, as you know. They make a lot of money on this stuff, but conversely, for their own account, they buy boatloads of guaranteed products and life insurance and annuities. So it's complete hypocrisy.
Chapter 12 of the book is entitled Bankers Love Guarantees of Life Insurance Companies, and it talks about how former Federal Reserve Chairman Ben Bernanke plays it safe with annuities.
Yep.
Federal Reserve Chairman Janet Yellen, pension annuities are her largest family asset.
Yes. The
Federal Reserve 401k thrift and savings plan, you found that fixed annuities are the biggest asset.
Yes.
Isn't that something?
Yes.
Isn't that something?
Yes, and God bless you, Jerry, for speaking the truth, because when I originally came up with this research in 2009 or whatever it was, and I did a press release on this, Jerry, the only one who picked it up was a paper in London, the International Business Times, but no one else in this country would pick it up, and it's all true, because as you know, in the book, and people can go to my website, by the way, www.barrymajamesdyke.com if they want the book. I even have it on Amazon yet. But as you can see in the book, I actually took the Deloitte audit and put it into the book. And when I found that, because I knew it was going to be invaluable for consumers. But it's all true.
That's absolutely amazing. I mean, this book is just filled with that kind of information. By the way, I want to talk to you about this real quickly here while we have you on the air, Barry. We had talked off the air about the upcoming conference that we're going to be doing in Estes Park, Colorado, and you were able to confirm that's something that you want to do.
Yeah, definitely want to do. It'd be a nice time to be out in Colorado, and the people you have, the quality people, and yourself and your integrity, I'd be definitely want to do that.
We're going to look forward to having you there as an addition. That's going to be wonderful, and he'll be there talking about much of the stuff that you hear about in this book and in this interview. Let's talk real quickly about insurance and annuities, because in the mainstream press, and as you're documenting here in this book, how annuities and life insurance are heavily used by those same people who market to the end user. They market things like mutual funds.
Yep.
Where now, as I think you've documented, $17 trillion of money in the mutual fund industry at least.
Yeah, yeah.
And all that money, of course, is assets under management. It's a lucrative scheme that has been foisted upon the American people. And I'm not saying that there's not a place for it. I want to certainly speak to the mutual fund advisors in our audience, not to say that mutual funds themselves are necessarily terrible things. It's just that there seems to be a great imbalance today in the type of financial education that most people receive. And Barry, you're filling that gap with books like this.
Yeah, well, thank you. Well, yeah, it's the truth. And one of the things, Jerry, which is not in my book, and it'd be good for your listeners to know this, and because I just got back from Las Vegas. I spoke in Las Vegas last week on this very issue at a conference, and some of the big, what the biggest, one of the biggest seller of fixed annuities is in the country is?
I don't know, Bank of America?
No, Fidelity Investments.
Fidelity.
Yeah, Fidelity. So Fidelity tells everyone, they have actually a full-page article ad today in the Wall Street Journal today, and about why they believe in active management. But conversely, if Fidelity for their private client groups, they're a huge seller of fixed annuities from major name brand life companies. And as a matter of fact, I have the white paper on Fidelity's actually been doing this for their high-end clients since 2003. So they what is called as a 4-box strategy. So what I'm just doing, Jerry, is I'm just trying to incorporate some of the high-end financial planning which Fidelity's been doing for their large clients since 2003. And I actually met the guy who actually developed the whole program with Fidelity. So this is the kind of hypocrisy which you're seeing. I think there's another one, which I don't think any of your advisors would be involved with. You ever heard of a guy by the name of Ken Fisher?
Sure.
Well, he's the guy who says, I hate annuities.
He hates annuities.
Oh, does he hate annuities? Okay. Now, want to hear this one? And I hope all your audience listens to this one, because people flip when I gave this statistic out in Las Vegas. American Equity, which is one of the a large life publicly traded life company out of Idaho, I guess. It's a good company. I don't do business with them, but they have good financials, and they have built a really good product. And I don't do any business with them at all. But you know who one of the major institutional shareholders is of American Equity Life, Jerry?
Who's that?
Fisher Investments.
Isn't that something?
So this is the whole thing. So Fisher's saying, Ken Fisher says he hates them, but his own asset firm. And anyway, if it doesn't believe me, they can go on to Yahoo, go into Major Shareholders tab, and look at Fisher under Fisher Asset Management. So Fisher Investments is actually a major shareholder in a major life company in the United States.
It's the same thing that you've been uncovering. I mean, what you're talking about is something that you've been researching now for a long time, but it's the same thing that we see with a lot of the shills. And I should be careful with my language when I use, I don't want to call them shills necessarily, but there's a lot of financial education that's passed off as financial education by people who have real white teeth, real shiny smiles, and they pass off this information that almost sounds like it's being robotically delivered by a bank. It basically tells them to put all their money into the banking system. And, you see this with people like, Dave Ramsey or Susie Orman. These folks who, they tend to preach a mantra that really benefits the mutual fund companies, don't they? Yeah,
and this is the whole thing. And Dave Ramsey, no question about it, Jerry, is the debt, personal debt, corporate debt. The country's debt is a huge problem, and I couldn't agree with him more about that. But in terms of his telling everyone they can get 12% in the market is really totally a lunacy. And as you know, in my new book, and again, people can get this at www.barrymajamesdyke.com, the largest sovereign wealth funds in the world, which would be the CalPERS, which is the largest pension fund in the United States. You know what they get for rate of return, Jerry, on their assets, with their $300 billion in assets?
No idea.
Year?
Gosh, 1%.
You nailed it. Yeah, so they get 1%. So, but they have an assumed rate, Jerry, as you know, about 7.75%, 7.5%. So the largest institutional investor in America, which is CalPERS, only get 1%, with their projecting 7.5%, 7.5 to 7.75%. Actually, the largest sovereign wealth fund in the world, pool of money, is Japan. Over a 10-year period, Jerry, they've only gotten like 1.7%. And the Norwegian sovereign wealth fund, which is the number 2, because they have the North Sea oil, over a 15-year period, Jerry, they only get about 3.177%. So the whole idea that even these big institutions make money in the market is a fallacy.
Well, we're certainly seeing a lot of fear in the market, and that drives demand for safer assets like life insurance and annuities. And let's talk about that for a moment in conclusion, because I think that's That's really the catch-22 here for many people, is that they have heard for so long that annuities and life insurance are these evil products that you should avoid at all cost. And people who have listened to our 5 levels of financial freedom or who have read our book, they know that we view every single financial product as a tool, right? It's simply a tool and nothing more, nothing less. So there's no really good tool, there's no really bad tool. It all really depends on what you want to achieve. And it seems as based upon the retirement crisis, the pension crisis, there is a tremendous need for guaranteed income, which is the title of your book. And that's exactly what you're documenting in this book, that many of the top people like Bernanke and Janet Yellen and others are relying upon for their own family's wealth. They're putting their money into things like annuities, which are maligned by the banks and the corporately controlled media. Is that what I'm understanding you say?
Yeah, it's understood. You nailed it, Jerry, 100%. But one of the great things, and I don't know if you've gotten to this, if you've seen the research in my book, but did you see what I discovered about how major corporations are de-risking using these things?
Yeah, talk to us about that.
Well, this is the thing, is that what I've discovered, okay, and this is, again, God's grace, but what I discovered, Jerry, is the major corporations are saying, i.e. General Motors and Verizon and Bell System of Canada and British Airways and Bristol Myers Squibb, and Motorola and Panasonic, all these other major corporations, and it's even bigger in the United Kingdom, the UK, and I brought out my research in the United Kingdom, is that they're saying we can't manage these pension benefits anymore. We can't manage our own retirements, Jerry. They're throwing the towel in, and they're buying monster annuities. So they're saying we can't. They're
basically outsourcing the risk to the best risk managers in the world.
Exactly. And I think really the classic case is the biggest case. And I hope everyone just, they Google this, they don't believe me. They should look at the case of General Motors. I mean, you and I had to bail out General Motors, and but this is a matter of fact. In 2012, General Motors purchased a $29 billion worth of annuities to offload their pension risk for their salary population, covering 110,000 employees. You know who placed the annuity? You know who was the broker on the annuity, Jerry?
Fisher Investments.
No, close. Morgan Stanley.
Oh, my God.
Close. So, this is, so again, I wouldn't say this unless I knew it wasn't true, but it is true. So Morgan Stanley, which makes, billions and gazillions off of speculating with your money, actually was the broker, official broker for the, placing the, $29 billion annuity to offload, General Motors, pension risk. This is also true for Verizon. Verizon did it for, $8 billion. And, so it's amazing. This is, so with some of the bigger ones, the name brands, TRW, Motorola, EMI Music, NCR, Timken, TRW and Motive, Church of England.
But Barry, I really like how you included also the target date funds in this book, because that was some important research that you had done. By the way, you're listening to the voice of Barry James Dyke. He's the author of a brand new book, Guaranteed Income, A Risk-Free Guide to Retirement. He's also written a couple of excellent books entitled The Pirates of Manhattan, and then there was a sequel, wasn't there? Yeah. Pirates of Manhattan 2.
Highway to Surf.
Yeah, and both of those books very eye-opening as well, documenting much of what Barry is talking about here. But you also listed these target date funds, Barry, in the new book, which I'm really glad you did, because those, as we well know and as you have been preaching, are becoming extremely popular and are dangerous. Tell us why they're dangerous.
Well, by the way, if people go on my the website, Jerry, you get a kick out of this. Jack Bogle, the founder of Vanguard, wonderful.
Oh, sure.
He actually endorsed the book. He liked what I was doing. He said this book was rich in passion and detail. And
wow! Congratulations, Barry. So you have a testimonial from Bogle.
Yeah, from the founder of Vanguard.
Wow, that's wonderful.
Yeah, so he's a very honest, he's a wonderful guy. But even Jack has Vanguard, as you know, they are the largest asset manager now.
Oh, sure.
In the United States, and they took in $256 billion in new assets, and they have the low cost index model. But the problem with them is, and I actually I know this for a fact, is that although they're a big sponsor of the target date funds, was doing work for an executive of a major public company. And Vanguard is the trustee and the custodian of the deferred compensation plan, Jerry. And as part of this prospectus, they disclosed the institutional track record of the target date funds, the entire list of all of Vanguard's funds. And do you realize, and this is as of September, every single target date fund that Vanguard has, every single one of them has lost money, Jerry, since inception.
Barry, what do you tell people who have 401ks? Because they really are trapped with just a few. If they don't have the brokerage link, what recommendation? I know you can't give specific advice, but what's your general advice to people with 401ks who have money in it and they're still working and they don't have the ability to pull it out? What should they do?
Gee whiz, it's I guess maybe if it's just a savings vehicle, just to take advantage of the savings component, Jerry. This is and I'm not against indexing. If there going to be any type of and I guess, again, I'm not against the market, Jerry, but, I would prefer them to have some type of low-cost index fund. But these target date funds, which essentially have been investment du jour of all retirement plans in the United States, and they've performed horribly. So I just tell people, Jerry, they can even put money into a money market account, or hopefully they have a guaranteed account of some sort, or some low-cost multi-asset class index fund. So I'm not a big believer in active management anymore. Some people can do it, but for most people, I just don't believe in it at all.
I think it's a dying model. I think you're right. And the robo-advisors are taking over, too. That's been a big, big topic as well.
Well, yeah. And the problem with the robo-advisors, Jerry, that's just another scam. Mm-hmm. That's just another part of the Silicon Valley scam, the latest thing from Silicon Valley.
So it's just FinTech. Basically, they're sharing revenues with their tech buddies.
Yeah, you're going to pump and dump.
Barry, both you and I saw this 2008 financial crisis coming. I mean, it was on the wall, and you and I met shortly thereafter, right in the wake of that 2008 crash. Do you sense another one coming? Does your radar sensor, as you look out and you see the debt accumulating, you see the fear mounting, you see the economic numbers coming in, you see the commodity prices being smashed, you see central banks in disarray, you see the banking sector of Europe, in shambles, and this one here in particular also getting blasted here in the United States. What's your sense about the global economy right now, and how sensitive are you feeling that maybe we're on the cusp of something big here?
Well, let's look at the facts. In the book, and again, people go to barrymajamesdyke.com, they can get the book, but let's look at the facts, Jerry. The equity exposure, and Morningstar did an analysis, actually, but Vanguard did an analysis of Morningstar data, and they found that the equity exposure for individual consumers, your listeners, is higher than it is today in 2016 than it was in 1999 and 2000, and it's higher than it was in 2006 and 2007. And we all know what happened after that, Jerry. Let's look at another fact. Let's look at the participation rate, the actual participation rate. Although the markets have been at all-time highs, the actual investors, or actually individual investors on a whole, are actually staying out of the market. Let's look at another statistic, margin debt, and you probably know, you're very familiar with this, Jerry. I think the margin debt, Wall Street borrowing money for stock purchases at an all-time high. So generally, a very high margin debt is a sign of prior to a crisis or a meltdown.
Oh, sure.
So that's another problem. We've got the entitlement problems, as we know. We've got in the financial engineering, Jerry, it's criminal. The stock buybacks, and actually Fortune did a great piece on this, and on Apple, how Apple, the stock everyone loves to own, has spent something ridiculous, $87 billion or whatever, buying back their own stock at average price $115 a share. And what's Apple today? $94.
Something like that.
So, and it's financial engineering. Okay, they've actually lost $15 billion. So another sign of financial engineering is the huge amount of borrowing to fund debt-funded dividends, primarily in the private equity industry, but also people like Apple. So they're actually borrowing money to fund dividends. So it's just crazy. So instead of returning value to the shareholders, it's being contributed to financial engineering.
Your clients are protected from such a downturn. Is that true, and how?
Well, yeah, this is the thing, is that using life insurance and annuity products, as you know, it's a contractual guarantee. And it's a promise to pay and all this other stuff. And this is the thing with the financial products of these mutual funds and stocks, Jerry, as you know, all the investment risk, the interest rate risk, all the kinds of the risks have been dumped onto the consumers. But if I put my money into a life company, the insurance company absorbs all the risk. They absorb the interest rate risk, they absorb principal risk, and so forth. So granted, and this is a correct comment, that the yields have been low, but at least people are going to have their principal protected. So today, I'm going to go back to the old Will Rogers saying, which he said in the 1930s, about why he had so much life insurance and annuities. Will Rogers said, I'm more concerned about the return of my money than the return on my money.
Right.
And so when you see this, what Will Rogers said, I don't know, roughly 80 years ago, this is more important for the consumer today. Makes sense.
Makes sense. The voice you're listening to is Barry James Dyke. The book, Guaranteed Income. Go to his website, barryjamesdyke.com. Pick up a copy of this book, Guaranteed Income. Read it. Inform yourself. Educate yourself. And if you want to reach out to Barry, if he's somebody you would like to speak with, you can contact him right through our Christian Financial Advisor Network. Simply go to ftmdaily.com/advice. Fill out the form. Let us know you want to talk to Barry. We'll put you in touch, and it'll be a completely free, complimentary session for you to learn more about if Barry can help you with your finances. Barry, thank you so much for joining us today. It's such a great pleasure to have you back on.
Thank you so much, Jerry. God bless.
I see problems down the line.